Hello friends, let's break down the Fed rate cut in detail. Well, yesterday they reduced the rate by 0.5%, went from 5.25% to 5.5% range down to 5 to 4.75% range. It was a strong move, something we haven't seen since 2008. Now, who wins out of this? Credit card borrowers, people who have car loans, home equity loans, business loans, credit lines, things like that. Businesses, small and big, are going to be able to borrow money more cost effectively, which is a great thing. However, mortgages, well, this was largely baked in. Overall, it's probably a long-term win, but in the short term, it's neutral. Now, if we look at what's next, or how we understand why it's baked in, we can look at the mortgage-backed securities, how things traded yesterday. We can see at the beginning of the day, we started at about 101.5 basis points, right? So that's where we started, and the announcement was actually made at 2 o'clock Eastern. So this is where the announcement's made. You can see that there was a nice rally. Understanding when we get higher on this chart, people get lower mortgage rates when they initiate. When we get lower on this chart, that indicates higher future mortgage rates. And by the end of the day, though, we were down, right? We had gone down, so that indicates that we could expect higher mortgage rates in the short term. Right now, this isn't as volatile as it could get, so it's not a huge deal, but nonetheless, it's important to understand that's why we think things are baked in. Now, what's next? We can look at the dot plot from the Fed Reserve Governors Meeting, where the Federal Reserve governors predict where things are going to be in the future. And this is where we're at right now with the most recent rate cut. They expect to drop another 0.5 point by the end of this year, and by the end of 2025, yet another 1 to 1.5 points, and by the end of 2026, another 0.5 point therein. Right now, that looks pretty compelling, but Fed Reserve rates are not mortgage rates. However, if we use the Fed Reserve rates to predict mortgage rates, and we look back in the past and see, well, when did we have Fed rates of what they're predicting or what they are today versus mortgage rates, we can learn something or potentially predict our future. So right now, Fed fund rate was just reduced to 4.75% to 5%. And the last time we saw that was in August of 2008. And at that time, we had mortgage rates of 6.47%. When we look at the previous time, that was back in 2001 in April, and mortgage rates were 7.12%, which means we would expect mortgage rates in the near-term future to be somewhere in this box. But right now, they're much better than that. They're at 6.2%. So this is why we think things are baked in. Now, if we go back to where the Fed expects rates to be at the end of the year, right? That's even further down, right? We're going to drop off another 0.5 point. And if we look back in the past, if we reach these levels, mortgage rates at the time where last time we saw these levels of Fed rate were at 6.24% and 7.14%, and we would expect us to be right in that area. And again, we're lower than that at the moment. So we could see that the end of 2024 cuts, that next 0.5 point off of the Fed rate, may be already baked into our current rates for mortgages. If we look even further out to the end of 2025, where the Fed expects their rate to be somewhere between 3% and 3.25%, well, last time we saw those Fed rates, mortgage rates were 5.6%, and the previous time before that was 6.8%. There's your range yet again, and here's where we're at today. So we're right in the middle of that range. So we might have priced in some of that change for between now and 2025, but it might get better. We might see a potential reduction in mortgage rates of 0.5% by the end of 2025, which is certainly good news. But the question is it worth waiting? So if we look at that, if we look at mortgages at 6.2 versus 5.67%, well, on a $750,000 mortgage, that rate difference saves you $255 a month. However, over a 16-month period, you can keep in mind we have to potentially wait to the end of 2025 for that reduction. Home prices are likely going to get about 6.5% more expensive, just based upon how they've been trending over the last 3 years. This means that the price of the home that you could buy today is likely going to be up by about $61,000. Your down payment is going to be up not $49,000, but about $12,000. Your mortgage is going to be up by $49,000, and your payment is going to be up by $27 a month because of this difference in price, even though you've got a lower mortgage rate. I think that's important to recognize. So when we look at all of this data, right, and we think about, is it worth waiting? Well, probably not, based upon how things are going to go, based upon their predictions, right? And understand this is the most optimistic prediction, or at least the optimistic version of their predictions. So if you've got questions, love to answer them. Give us a call. Hope this detailed explanation is helpful for you in your planning and understanding of today's economics, and thanks for watching.